Hello everyone, welcome back to the channel. Today we'll be analyzing a topic that's attracting a lot of attention worldwide. What will happen to the US dollar if Iran blockades the Strait of Hormuz? Will the US dollar surge due to its role as a safe haven asset? Or will it weaken under pressure from soaring oil prices and the risk of a global economic recession? In this video, we'll delve into the biggest impacts on financial markets, oil prices, gold, and the short-term and long-term trends of the USD. If you enjoy content about finance, economics, and the hottest geopolitical developments in the world, don't forget to like, subscribe to the channel, and turn on notifications so you don't miss the latest analysis videos. Your support is the motivation for the channel to continue bringing you more quality and engaging content every day. Now, let's get started with today's topic. What would happen if Iran blockaded the Strait of Hormuz, the world's most important oil shipping route? This is not just a simple geopolitical event, but could become a major shock to the entire global economy. Even a few days of closure of this route could instantly destabilize financial markets. Oil prices would surge. Gold would jump sharply, stocks would plummet, and the US dollar would fluctuate wildly. With approximately 20% of global oil passing through Hormuz, any disruption would be enough to cause severe strain on the world's energy supply. In the market's initial reaction, oil prices are typically the most volatile asset. Investors fearing supply shortages quickly pushed Brent crude prices higher, with many experts warning of potential gains of $150 to $200 per barrel if the blockade continues. When oil prices surge, global transportation, production, and consumption costs rise, leading to inflationary pressure in most economies. In this context, the US dollar tends to appreciate in the short term. The reason is simple. When war or crisis erupts, investors often seek assets considered safe havens, and the USD is always a top choice. Money typically flows out of stocks, cryptocurrencies, and risky assets to the US dollar. Therefore, the more instability there is, the greater the demand for holding USD. In fact, during recent tensions related to Iran, the USD index recovered strongly thanks to its role as a safe haven asset. Besides the safe haven factor, oil on the international market is primarily priced in USD. This means that when oil prices rise sharply, oil importing countries are forced to buy more USD to pay for it, thereby creating additional demand for the currency. This is why the USD often benefits when a blockade of the Strait of Hormuz arises. However, the story doesn't end there. If the crisis lasts for weeks or months, the negative impact could backfire on the US economy. Excessively high energy prices would drive inflation in the US, reducing consumer purchasing power and putting pressure on economic growth. In that case, while the USD might strengthen in the short term, it risks weakening in the medium term if the market fears a US recession. In short, if Iran blockades the Strait of Hormuz, the USD will almost certainly strengthen significantly in the short term due to safe haven sentiment and demand for oil payments. But in the long term, the trend will depend on the duration of the crisis and its impact on the US economy. This is the most fascinating aspect of this topic. A geopolitical event can reverse the course of global financial markets in just a few hours. The Strait of Hormuz is considered one of the world's most strategically important shipping lanes. Situated between Iran and Oman, connecting the Persian Gulf with the Gulf of Oman and the Arabian Sea. It is the lifeline of the global energy market. With approximately 20 million barrels of oil, nearly 20% of the world's total oil consumption, transported through it daily. This figure alone demonstrates the strait's vital importance to the world economy, especially for countries heavily reliant on energy imports such as China, Japan, South Korea, and many European nations. Not only crude oil, but a large amount of liquefied natural gas, LNG, also passes through it, making Hormuz an extremely sensitive choke point in the global supply chain. Imagine the Strait of Hormuz as a lock valve for the world's energy supply. When this valve is functioning normally, oil and gas are continuously transported to factories, airports, vehicles, and millions of businesses across the planet. But if this route is blocked due to military tensions, the entire energy flow can be disrupted in just a few hours. This immediately creates panic in financial markets, driving oil prices up due to fears of supply shortages. In fact, just the news of Iran potentially blockading the Strait of Hormuz often triggers a strong reaction in oil prices. Investors and hedge funds will push oil prices higher due to concerns about supply disruptions. A blockage of this route for just a few days can cause oil prices to surge by 10% to 20%. Or even higher if the conflict escalates. This leads to a series of consequences: increased transportation costs, higher fuel prices, increased global inflation, and significant pressure on stock markets. It's worth noting that the Strait of Hormuz has few effective alternative routes. Although some Gulf countries have pipeline systems to other ports, their capacity is insufficient to cover the enormous volume of oil that passes through this route every day. Therefore, the financial world consistently views Hormuz as one of the most dangerous bottlenecks of the global economy. Simply put, even a short-term blockade of the Strait of Hormuz can have a global impact on gasoline prices, commodity prices, and significant fluctuations in the US dollar, gold, and stock markets. This is why, whenever tensions between Iran and the West escalate, all eyes turn to this small but extremely influential region. As soon as news emerges that Iran may blockade the Strait of Hormuz, the initial reaction from global financial markets is usually extremely strong and almost immediate. First and foremost, oil prices are the quickest to react because the Strait of Hormuz is considered the world's energy lifeline, transporting approximately 20% of global oil daily. When the risk of supply disruption arises, investors immediately push Brent crude prices soaring due to concerns about severe shortages. During recent tensions, oil prices have at times increased by 8% to over 12% in a single trading session. And many financial institutions warn that Brent could easily surpass $120 to $150 per barrel if the blockade continues. Simultaneously, shipping costs and insurance premiums for oil tankers have increased sharply. Shipping companies and insurance firms typically rate the Strait of Hormuz as a high-risk area whenever military conflict escalates. This causes the cost of chartering oil tankers, war insurance, and international freight transportation to rise rapidly. Simply having ships diverted or waiting outside the designated area is enough to disrupt global supply chains, driving up fuel and consumer goods prices. Not only oil, but gold also typically surges in the early stages of a crisis. When fear grips the market, money tends to leave risky assets for safe havens like gold and the US dollar. Investors fear widespread war, rising inflation, and weakening economic growth, so gold becomes the top choice for preserving asset value. This is a very familiar reaction whenever major geopolitical events occur. Meanwhile, stock markets often fall sharply. Shares of companies dependent on energy, transportation, and consumer goods are easily subject to sell-offs due to concerns about rising input costs. Investors often quickly sell risky assets such as stocks and cryptocurrencies and shift their funds to cash, bonds, or gold. Major stock indices in the US, Europe, and the Gulf region often experience sharp fluctuations, sometimes even plummeting within the first trading session. When bad news emerges, when war or geopolitical tensions erupt, the US dollar is often one of the strongest appreciating assets. And this scenario is even more likely if Iran blockades the Strait of Hormuz. The first and most important reason is that the USD is considered the world's leading safe haven asset. Whenever the market panics, investors quickly sell risky assets like stocks, cryptocurrencies, and emerging market currencies to shift their funds into the US dollar. This is a very familiar reaction in global financial markets. The more instability there is, the more money flows into the USD due to its high liquidity, safety, and its role as the world's #1 reserve currency. In the recent days of escalating tensions around Hormuz, the USD index has risen significantly thanks to this safe haven flow. Simply put, when war breaks out, the general sentiment among investors is to get out of risk as quickly as possible. They sell stocks fearing a sharp market crash, sell crypto due to excessive volatility, and hold cash in USD to protect their assets. Therefore, the dollar often rises sharply in the short term. This is also a very catchy phrase for your video: the more chaos, the more money flows to the dollar. This phrase is both easy to understand and creates a dramatic effect for viewers. Beyond the safe haven factor, another very important reason for the USD's rise is that oil on the international market is primarily priced in USD. When the Strait of Hormuz is threatened with a blockade, oil prices often surge due to concerns about disruptions to global supply. Many financial institutions have warned that oil prices could exceed $150 per barrel, even approaching $200 if the disruption is prolonged. When oil prices rise, oil importing countries like Japan, South Korea, India, and many European countries are forced to buy more USD to pay for energy contracts. This creates a huge real demand for the dollar, not only from investors but also from central banks, energy companies, and importing countries. In other words, the higher the oil price, the stronger the demand for USD, thereby supporting the upward trend of the currency. In addition, rising oil prices raise concerns about a return of inflation, leading the market to expect the Federal Reserve System to keep interest rates high for longer. High interest rates are also a strong support for the USD because global capital flows tend to seek dollar-denominated assets to benefit from better yields. However, Iran's blockade of the Strait of Hormuz doesn't always guarantee a sustained rise in the USD. This is a deeper perspective and very suitable for in-depth analysis in your video. In the short term, the USD usually strengthens due to safe haven flows and demand for oil payments. But if the crisis lasts for weeks or months, the dollar could weaken in the medium term. The reason lies in the ripple effect of excessively high oil prices on the US economy itself. When the Strait of Hormuz is disrupted, oil prices typically surge due to concerns about global supply shortages. If these prices persist, fuel costs in the US will rise sharply, leading to increases in gasoline prices, transportation costs, production costs, and consumer goods prices. This creates significant inflationary pressure on the US economy. Experts have also recently warned that the oil shock from the Middle East is increasing the risk of stagflation, high inflation coupled with slow growth. When inflation rises due to energy prices, Americans have to spend more on gasoline, electricity, and daily necessities. This reduces consumer purchasing power. Businesses are also heavily impacted by rising input costs, leading to shrinking profits and slower production. Once consumption weakens and businesses reduce investment, US economic growth will begin to stall. This is precisely the factor that could cause the USD to lose strength after its initial surge. The bigger problem lies in the Federal Reserve System. When inflation rises sharply due to the oil shock, the Fed will be in a very difficult position. If it cuts interest rates to support growth, inflation could flare up even more. But if it keeps interest rates high for too long to control prices, the economy risks a deeper recession. Many recent analyses show that the Fed is stuck between two goals: controlling inflation and protecting growth. This tug of war is the reason why the USD could weaken in the medium term. Initially, safe haven flows will push the dollar higher, but as the market begins to shift its attention from the war to the health of the US economy, sentiment could change rapidly. If investors perceive US growth slowing, the labor market weakening, and the possibility of interest rate cuts returning, the USD will come under selling pressure. A recent survey of currency strategists also suggests that the USD's war-induced recovery may be temporary and easily weakened when tensions ease or when the negative impact on the US economy becomes clearer. Looking at it from a short-term and medium-term perspective, this is the most important aspect in understanding the trend of the USD when Iran blockades the Strait of Hormuz. In the short term, the market will almost certainly react very quickly to a sharp increase in the USD. This is because panic often arises immediately after news of war, oil supply disruptions, and the risk of escalating conflict in the Middle East. Global investors tend to withdraw money from stocks, cryptocurrencies, and risky assets to hold cash, US government bonds, and the USD. This is an instinctive reaction of financial markets. The more instability, the more money flows to safe haven assets. At the same time, the sharp increase in oil prices due to concerns about supply disruptions further increases the demand for USD. As oil worldwide is primarily traded in US dollars, currently, the disruption at Hormuz has pushed oil prices above $110 120 per barrel, increasing the strength of the USD in the initial phase. However, looking at the medium term, the trend is no longer simply an upward trend. At this point, the USD will depend on four crucial factors: the duration of the lockdown, the extent of the conflict, the Fed's response, and the evolution of oil prices. If the strait is only disrupted for a few days or 1 to 2 weeks, the market usually views this as a temporary shock. Oil prices may then cool down, and the USD after its initial surge, will gradually stabilize. But if the lockdown lasts for months, the situation will be completely different. High oil prices will put inflationary pressure not only on Europe and Asia but also heavily impact the US through gasoline, transportation, and consumer goods prices. The IMF also warns that prolonged conflict in the Middle East could lead to higher prices and slower global growth. The third factor is the Fed's response. This is the key factor determining the direction of the USD in the medium term. If the Fed keeps interest rates high for longer to control inflation stemming from the oil shock, the USD will continue to receive strong support. Conversely, if the US economy begins to weaken significantly, the labor market slows, and the Fed signals interest rate cuts to rescue growth, the USD could reverse its upward trend and fall. Currently, the Fed remains cautious, believing the oil shock may only be short-term, but they are prepared to adjust if inflation expectations rise again. In short, if Iran actually blockades the Strait of Hormuz, the most likely scenario is that the USD will surge in the short term, almost as an immediate reaction from global financial markets. The reason is clear: whenever war or geopolitical tensions erupt, investors always seek safe assets, and the US dollar has long been the leading safe haven for global capital. As soon as information emerges about the risk of disruption to the planet's most vital oil shipping route, the market will immediately react by selling off risky assets such as stocks, cryptocurrencies, and weaker currencies to hold USD. This is a very strong psychological reaction, often occurring within the first few hours of a crisis. Beyond psychological factors, the USD is also supported by the oil shock itself. Because the vast majority of global oil transactions are denominated in US dollars. When oil prices surged due to the threat to the Strait of Hormuz, oil importing countries were forced to buy more USD to pay for them. This created a huge real demand for the currency. Therefore, in the short term, the likelihood of the USD rising is very high, possibly even much more sharply than other safe haven assets in the initial phase. However, what makes this topic so interesting and debatable is what happens after that initial surge. If the crisis doesn't end soon but drags on for weeks or months, the negative impact will begin to roll back into the US economy. Excessively high oil prices will cause gasoline prices, transportation costs, and commodity prices to escalate, thereby driving up inflation in the US. When people have to spend more on energy and essential goods, purchasing power will decrease, businesses will face greater cost pressures, and profits will shrink. This is when the market begins to shift from a safe haven mentality to one of concern about the health of the US economy. If growth slows, the risk of recession emerges, and the Federal Reserve System is forced to change its monetary policy. The USD could gradually lose strength. Some market strategists have also recently argued that war-induced rallies are often strong only in the initial stages, then weaken as investors begin to assess the long-term economic impact.